Welcome to another episode of Taking Stock for the week ending the 31st of October 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to bring to you all things share market. Welcome, Jace. Great to have you on board today.
Thanks, Ken. It's going to be one of those special Halloween editions. What are you planning to do with the kids?
I think I've already had my party last week, Jace, but as
That's
always,
spectacular.
the information we share today is of a generic nature and doesn't take into account your personal situation. Remember, shares are volatile. Any past performance figures aren't a reliable indicator of future performance. Well, Jace, global markets very mixed signals this week, and
Mm.
they took investors for another ride. But the tone was generally positive offshore. In the US, equities rallied to record highs after softer inflation data and strong quarterly results from major tech and industrial names boosted optimism about this soft landing. Investor sentiment also improved following the meeting between Presidents Trump and Chinese Xi at the APEC summit, which signaled progress on trade and rare earth tariffs.
Yeah, that's right, Ken. I think there was a lot of positive sentiment that flowed through post that meeting. However, the broader ASX struggled to keep pace after a surprise jump in the September quarter CPI, and that showed inflation running pretty hot at 3.2% year on year. The print was obviously above expectations and therefore ruled out any chance of an RBA rate cut in late 2025.
Yeah, quite a stark disparity between our market and also US markets with rates
Mm.
coming down there. But the results did trigger a sharp sell-off in rate-sensitive sectors here, such as REITs, information technology, and consumer retail, with the latter being hit harder by softer trading updates from JB Hi-Fi and also Wesfarmers as well. And both retailers, they did point to cautious consumer spending and lingering cost pressures, adding to concerns about household demand. Meanwhile, a few governance issues are also weighing on our star stocks like
Mm.
Wisetech and Steadfast. But let's turn now to some more positive news with the AGM season remaining in full swing. Let's talk about starting off with star income stocks. AUB Group, Australia's largest insurance broking network. Now, the big news this week was a takeover offer from Swedish private equity firm EQT, valuing AUB at around $45 per share. And that's a 35% premium from where the stock was last trading.
Mm. Yeah, that's right. It was a pretty healthy, decent bump up in the share price, Can. But despite the premium, the offer does look pretty attractive for EQT when you consider that AUB's strong recurring cash flow and also dominant position in the local broking market means that they can achieve a little bit of scale and efficiency as well. AUB has also successfully integrated its US acquisition of Tysers, and that's with strong earnings growth helping to underpin some of the growth in dividends over the period. The stock also trades above market dividend yield at around 3.8%, so that looks pretty healthy as well.
I know, still sounds quite attractively priced. So, what should investors do here? The
Mm.
stock does continue to trade well below the offer price, given that the proposal remains conditional and not guaranteed to proceed. Some investors may wish to take profits, although at these prices, the stock continues to trade close to fair value and doesn't seem expensive at all. Let's now turn, Jace, to one of your stocks, Jumbo Interactive, the online lotteries reseller behind Oz Lotteries. The company made headlines again this week after announcing another acquisition, the acquisition of Dream Giveaway USA, a well-established US-based charitable prize draw operator, for around 58 million.
Yeah, that's right, Ken. It was a pretty unexpected to have two acquisitions come in so closely, and this is off the back of the UK acquisition that the company made a couple of weeks ago. The latest US deal does give Jumbo a pretty good foothold into the US market, which adds another international growth pillar following its UK expansion, obviously a couple of weeks ago. The US operation provides automotive and also cash prices, which is very similar to what they do in the UK. And this is a model that has delivered double-digit growth and has a pretty loyal customer base of around 1,700,000 users. So it's a pretty solid operation.
And surprisingly, the share price sold off on the day.
Yeah.
Strategically, this acquisition does broaden Jumbo's global presence and strengthens its direct-to-consumer capabilities while also diversifying earnings beyond the Australian lottery reselling business. Management does expect the transaction to deliver low to mid single digit earnings accretion within 12 months, and these factors should support its ROE, return on equity, currently projected at around 38%. But will this change its dividend policy, Jace?
Well, Jumbo's target payout ratio has been adjusted to 65 to 85% of net earnings. And this is sort of under review with the board. They are expected to provide, obviously, an update on this at the AGM in November. But with some of the additional debt and sort of the strong cash flow generation, this should provide a bit more of a flexible capital management framework into the first half of 26. The current projected gross yield for FY26 remains above the market yield and is pretty relatively healthy at 6%. But I guess one of the things that management needs to ensure is that they have enough working capital to sort of funnel or fund the two businesses and therefore effectively leaving an option up their sleeves to sort of determine how much of that distribution gets granted to shareholders.
Yeah, we'll stay tuned on that, Jace. But next off the ranks is Wisetech Global, the logistics software group behind CargoWise platform used by freight forwarders and custom agencies worldwide. Now, the share price has come under pressure again, this
Mm.
time following news of an insider trading investigation. Jace, what's the latest here?
It just seems to be one of those things for Wisetech. In
Mm.
every couple of weeks, we have something different and out of the blue that comes. The latest, I mean, we were reading media releases that the Australian Federal Police and ASIC effectively executed a search warrant and they're alleging some form of insider trading, which involves founder Richard White and also the and also three other employees with the company as well. The allegations sort of point to around share sales made between the late 2024 and also early 2025 period. There was roughly around 200 or so million dollars worth of stock traded at that time. Effectively, ASIC sort of disputes that. That was the period when Richard sort of stepped down from the CEO and sort of transitioned into this quasi founder strategic role. And they sort of intimate that he does or still had possession of inside information and shouldn't have really sold shares at that period. I mean, to be clear, there's no charges being laid at this point in time, and there's no allegations being made against Wisetech itself. The company has said that they are cooperating with regulators, so it's just one of those things that we'll have to wait and see what happens.
Yeah, definitely, Jace. The stock is under review at the moment, but it is quite a significant development. Does
Mm.
this change the investment thesis around this?
Look, we've had a number of issues, not just with Wisetech, but also other companies as well relating to ESG. I mean, when you step back and look at it operationally, no. The sentiment is likely to remain weak because this does introduce obviously further governance and also reputational risk that's tied around the company, especially at a time where it's quite sensitive because it is integrating a relatively large acquisition such as the E2 Open deal, which is not really an easy task. So the reason why the stock is trading down, I guess, sort of reflects some of the discount to the premium that investors previously attributed to that stock.
Okay, thanks, Jace. And turning now for the week ahead with our corporate calendar, there's going to be a few major banks reporting. So we'll be very careful and watching out on that. Westpac,
Mm.
National Australia Bank, and also ANZ reporting over the next couple of days. Also, we have Macquarie as well, which we will be delighted in looking into their numbers just to see whether they do meet our model. So stay tuned for that. In Under the Microscope this week, we're taking a closer look at CSL, one of Australia's largest healthcare companies and a global leader in blood plasma therapies and vaccines. Now, the company did recently downgrade their financial year 26 earnings outlook. What's going on here again, Jace?
Yeah, it's a pretty disappointing one coming from CSL. Well, there were effectively two main factors in the media release this week, and the first one was obviously softer influenza vaccine demand, particularly in the US, and also secondly, we did see a temporary slowdown in terms of the China plasma collections, which followed some form of regulatory adjustments in the country. Those issues are seemingly cyclical rather than structural from our point of view, but they have obviously dampened earnings growth expectations through to FY27 and also FY28 as well. And management is expecting 27 and 28 to grow via high single digits versus consensus expectations for around 12% growth in those years, which is leading to some of the negative earnings revisions that are expected to come through. And what we've really tried to do here is display to a lot of the viewers what the weekly situation in the US looks like. So the chart on screen shows the weekly cumulative doses of influenza vaccines administered in the United States. And I'm not sure if you can sort of see, but the light blue line down the bottom represents the 2024 to 2025 period. And that's sort of comparing the COVID years, obviously from 2020 till now. Now, I do have to mention that during COVID, we did see a pretty large spike in terms of influenza vaccines, which is pretty obvious because a lot of people were relatively scared by the coronavirus and wanted some form of protection. It is going back to pre-COVID levels, 2024 to 2025, and that is representative of some of the D-rate in terms of where that earnings growth pipeline looks.
Yeah, definitely, Jason. I mean, the share price has sold off quite sharply after the update, and not surprisingly, that trend in vaccinations coming down, especially with the US government now, being anti-vax. But
Yeah.
why has sentiment been so pessimistic on this stock?
Well, as with most things, Kien, market tends to extrapolate short-term weakness. I mean, think back at ResMed when Novo Nordisk released GLP-1 drugs. Everybody said, "Hey, it's the end of sleep apnea, and nobody's going to exercise anymore. Everybody's just going to pop a pill, and we'll all be slim and gorgeous." So it's similar in the way. So CSL's margins are obviously moderating in some of its core blood plasma business. But I guess the main weakness is obviously coming from this influenza arm. So investors are pricing CSL to be more of a, I guess, defensive compounder, and any of the growth hiccup, I guess, sparks some type of outsized reaction that we have seen from investors. But fundamentally speaking, the business continues to expand its collection pipeline in terms of the blood plasma business. It continues to invest in new therapies and also broaden its vaccine pipeline. Sure, Securus is put on ice in terms of being sold out or spun off at this point in time. That's obviously conducive of a pretty weak US market. But I guess on the whole, it's a business that has been pretty solid.
Yeah, it does look, as you mentioned earlier, Jace, that the risks are predominantly cyclical. The flu vaccines, that softness reflects lower US immunization rates post-COVID, and also China's regulatory shift. That should eventually stabilize as well. But
Yeah.
structurally, CSL's markets, immunology, transplants, and also influenza, they still carry long-term demand tailwinds.
Yeah, we expect so, Ken.
Mm.
It's not one of those things where, hey, everybody stops requiring vaccines. I mean, Trump remains in power for his second term, probably towards the end of 2028. So if we do see any changes in the US health minister or even changes in president, which will obviously happen in the next 2 years, that could reset policy and things could be totally different again. But I guess in the near term, following some of the negative earnings revisions, the forecast return on equity remains comfortably around the 16% mark, which is for now still above our growth hurdles. The balance sheet also looks pretty solid, and the company is still supporting some type of a share buyback as well. And just keep in mind that the flu business only represents around 12% of total earnings, which is expected to forecast to come down to around 10% also in FY26. But nonetheless, earnings growth still remains intact, and there's a good chance the stock will still continue to obviously meet our health hurdles into the FY26 period.
Yeah, no doubt, Jace. The stock does look cheap on valuation metrics, but in the short term, sentiment will take time to improve, especially given other risks, including the overhang and uncertainty around US pharmaceutical tariffs as well. So investors will need to be patient with this one. And following on from that downside volatility, especially from CSL and Wisetech this week, a common question among investors is how should investors react when a company's share price falls sharply after an announcement?
Yeah, that's always a good question, Kien. In these type of cases, it's obviously best to try to be as objective as possible and remove any emotions from your process. The first thing to do would be obviously to assess the overall position of the stock within your portfolio. This is why maintaining a pretty well diversified portfolio is important. You have to ask yourself questions. For example, is the investment thesis still intact, especially around your growth and income objectives? Is there a chance the financial health of the business could deteriorate from here? Are there any risks? Are the risks transitory or are they cyclical? Or are they more structural and therefore longer term? And that could help you solidify some of your decision making. Or at the end of the day, are there better opportunities elsewhere? And, if I could offset some of the realized gains with some of these losses for tax purposes, that might also be a benefit as well.
Yeah, there's so many things to consider there, Jason. And as Benjamin Graham, as he once said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. In other words, emotions drive share prices in the short term, but in the long term, it's the fundamentals that matter.
Yeah, that's right. And I mean, for the investors that are looking at technical indicators, do consider applying some of the ones that we have within the Stock Doctor platform, and they could include the SD30 TSL, the SD Max as well. So here you need, I guess, a systematic approach and sell out and be really disciplined to buy and sell out at certain of these at certain trigger points as well, and that could potentially help some of your downside losses by putting that stop loss in place.
Yeah, that's right, Jason. And remember, though, investing in shares, it does require a time horizon of at least 5 years. And it's always almost impossible to get everything right. So if you invest in quality and if you invest in profitable companies, then over time, your winners should more than offset your losers. Well, that's all we have time for today. And thanks, Jace. Very full packed episode today, didn't we?
Yeah, that's right, Ken. And for any of the viewers, if you have any questions on any of the stocks, feel free to give our analyst team a call or otherwise join us for the Lincoln Live sessions every Monday.
Yeah, and until then as well. But before we wrap up, a quick yet important reminder, if you have friends or family who could benefit from Stock Doctor, please share our link with them. Our growth does come from members like you, and we truly appreciate your continued support. Until next time, take care and have a happy, healthy, and prosperous week ahead.